MMTs, I apologize if you're watching this video. The last video we kind of cut it off. It got cut off somehow. So hopefully our audio control is working. 2250 put, how to trade that side of the market. And what we're going to show you is that this side of the market was marked down from $80 a contract, and we're getting into wholesale ranges. And wholesale ranges down here could vary between our lower bids. There's a bid between $10.50 to $20 range. That's the ultimate range. But the near term second choice to that range is between $36 and $25 a contract. The moral is, MMT is how to make money off of it. $12.19, the contract was $80. Now, when we hit a bottom over here, we're overbought on the Nasdaq 100 itself. So the put's been marked down from all-time highs. Like I said, you can see up here, that was $140 a contract. And you can see here that these were a high right here of 153.84. So that was on 11.25, okay? Now, here on 11.30, they marked them down to 84.76. They finally got to their first tier structure of making a low of 49.30 where they were buyable on 12.5. And when the markets were pulling back, all based on Europe, we were buying these. These were the ones. They marked them from that $49 first tier market up to the high market of $70. So there was a move here in this 3-day period to sell. Now they marked them down again to be bought again right back over here at 50, and then the next morning they were marked up $10 on that gap, on this gap right here, and then they marked them back down to the low. But look at here, that was another buy at $47.90 and another markup to $85. What a whopping game. Then what'd they do? They marked it back down in value to $54, and guess what? Another markup to $80, but a close at $59. Those were the trading ranges. Now we're down to this tier structure level. This was the first markdown. So the markdown from the original high to the current level is $117 a contract minus. That's where stockmarketfunding.com MMTs are taught how to buy wholesale and sell back to public. That's what it's about. And when we're looking at doing that, we're looking at, in the same video here, this is a 24.75 call up and out of the money, and they too were up here on 12.5 of $24 a contract. So if you had 10 contracts, that's 24,000. If you had one contract, 2,400. But look at here, they marked this down too, and they marked it down to 60 cents on 12.19 on this 24.75 call. Yes, it's 200 points above the money. Does it ever even have to go close to that? No, it does not. It's how you can buy this side of the market. They marked it down. You can see in the video right here at this point, they marked that call down to nothing, to 60 cents. You can see also in the same structured here how they marked the put down. So they marked both sides down. The thing about it is, how do I get the wholesale value on this markdown? And because if there's any upside volatility, I'm in play at the most deflated price on a 24.75 up and out of the money call. Now I get this wholesale, and if I buy this at certain wholesale prices, this too is marked down. So I'm buying both sides of the market on a markdown value. And the same rule will apply here. If you take a look at the 24.50 call, which has also been marked down to a low. Remember, it's a $2,450 call. It doesn't matter. It was marked down $31.60 on 12.5. Today's 12.6. They were marked down to lows here at $1.05. That means that I'm buying that up and out of the money as a volatility risk management trade. Okay, yeah, they've gone up in value to 230 on the high, but they were wholesale down at $1.01. You get in at $1.10, you've got the upside volatility. In case the Nasdaq wants to break higher, you'll let that side run. It's been marked down in value. I'm getting wholesale here, and I'm entering wholesale for the put side of the market. And it's based on using that up and out of the money 2450 call as a risk management head. Now, here's a great one right here. Here's a great call contract, 2400. But look at the high, it was $50.90. Now they've marked it down in value at 330. That's a wholesale value to buy for up and out of the money. Remember, my friends, these calls at one time back on 1027 were $113.70. These are extreme wholesale levels. They have marked it down, just as they have marked the put down. They marked the call down. They marked the put down. This is and this is where the Nasdaq is trading at 2287. $2,400 call, $2,250 put. Let's take a look at the 2285 put. That's a very nice one to have. Why do I say that? That's a January, and you would want that 22, let's say 80 put right here. Now look at this. Look at the high the other day. This high on 12/19 was $96 a contract. They marked the low to $52, my friend, and we hit the low. That was a big haircut. I mean, if I'm buying one contract here, I'm paying $5,600. But the thing about it is, they marked down the 2280 put, and look at here. On Friday, you closed at 2287 on the Nasdaq 100. Isn't there something wrong with that? It's only 7 handles above it, but look at the big gap down. Look at that premium step. This is where our system tells you to buy, because no one ever buys down here and makes a market in volatility. That's that 2280 put that's deflated down here. It's never been that low of $52.80, and it closed at $52.80. Okay, and we're going to be looking at where the last one closes at 56, but the high is $56. That's $9 lower than this high. But remember, the low, they get down there in these ranges and they mark them down. We'll be looking at buying that put option as well. How to buy calls and puts. That's that strike price. There's another one, MMT, that we really enjoy, and this is the up and out of the money 2350 January call. They marked the call down. Yes, they did. Look at the last little peak here. They were $75. They got down here to $8.92 where you could buy, and then they gapped up to $24. What a nice trade. So you buy it at not $10 and sell at $24. They opened them at $15.7. Those were gap ups. They marked them down again to $9 on 12/21, 5 days ago. Yeah, happy holidays, happy New Year. And then the next morning, you didn't get nearly what you got when you bought them at $9 over here. But here's the thing: they did not mark them up. The high was $18.50. The high here was $18.50, and the high here was $19, and the low was $16.30. Now, listen, that $23.50 call has still been marked down in value, but just remember that they've come up about $10 off of that low, so they're not as marked down. But once again, how do I trade the Nasdaq 100? And here is, once again, the weekly Nasdaq 100 below the 10-week and the 50-week. If it gets above here, then the calls would go much higher. You could come right back up here. It's always possible. We'll let the markets figure that out. But we know that we're selling short into the earnings season in January 2012. So we're going to take advantage of every little part of what we can do, and that's going to be the upper resistance level. That's that weekly. That's the 10-week. If it crosses over the 50-week, every move, like we said, sell short into the rallies. That's your next resistance levels right up in here. Sell short into resistance. Weekly Nasdaq 100. combination and series of 2350 calls up and out of the money. Can't be one-sided to the market. That's one thing about the market maker. This is not a day trading model. This really teaches you the intrinsic value of being both sides of the market and bringing the cash register both ways. It's a much more better way of doing business, knowing when to buy that markdown on that 2400 call, and knowing when to buy the markdown on the 2350 call, and knowing when to buy the markdown, in the put. And I can tell you that a $2,300 put right here, you can see it's been marked down. This can get, marked down. We can mark it on down here in lower areas. But the thing about it is, that's in the money put on the index. We close at 2287, and we already know that. But when you get in to the value of that 2280 put, that's that one. The 2280 put, we're going to monitor this one. When they take out that much premium, that's the side we're looking at getting on at the right wholesale price.